Imagine embarking on a journey into the world of investment guidance and the wisdom of the one of the most renowned billionaire investors of our time. The first rule he imparts is the safety fly. Simple. The first rule of any investment is don't lose money. Follow closely by its companion. Remember the first rule. This pearl of financial wisdom comes from none other than Warren Buffett, celebrated for his unparalleled success in making intelligent investment choices. Delving into the essence of him quotes unveil a profound philosophy that underpins his extraordinary financial achievement. Warren Buffett, a luminary in a realm of investment, has long been celebrated of his astute financial acumen and his unique approach to wealth creation. His guiding principle, often detailed into the succinct was never lose money, underscores the paramount importance of receiving capital in the world of investment. However, this rule isn't as simplified as it might first appear. In fact, it encompasses a multiple strategy that has propelled Buffett to the upper echelon of the financial success. And the heart of Buffett's investment philosophy lies the concept of value investing, an approach where he actively seeks out undervalued companies and acquires their stocks at a substantial discount. This meticulously crafted strategy enabled him to not only minimize risk but also to maximize the potential of probability. What truly set Buffett apart, true, is his unwavering aversion to losses, a principle that has become synonymous with his name in the world of finance. In the unpredictable realm of investment, where earnings, stock market fluctuation, and the economic trend can be as capricious as the wind, Buffett's steadfast commitment to safeguarding the capital stands as a beacon wisdom. His belief is clear. It's not just about making the most money possible, it's about ensuring that you don't incur devastating losses. Buffett's legendary approach is perhaps best exemplified during times of market turbulence, such as the 2008 financial crisis. While many investors come to panic selling as their investment plumb in the value, Buffett remained resolute in his conviction. Instead of investing his holding in the hedge, he often opted to increase his stake in a company when he believed in the enduring strength of its fundamentals. But embracing Buffett's principle through grounded in prudence is a far from a straightforward endeavor. It demands a profound comprehension of a company's intrinsic value, unwavering passion, and the emotional resilience to weather the tempestuous of the stock market. The process can seem daunting, especially for novice investors, but as Buffett himself notes, we don't know what the stock will do. We don't know what the economy will do, but we do know that we want to be safer in terms of our eventual investment. In essence, Buffett's philosophy is about prioritizing risk management and capital preservation, often the allure of chasing extravagant return. It's essential to clarify that Buffett's rule does not advocate avoiding all investments that carry potential losses. Instead, it underscores the importance of making well-informed decisions and minimizing potential setbacks. This may entail avoiding ventures with high-risk profiles or favoring businesses with robust financial health and proven resilient business model that can withstand the volatility of the market. Before taking the plunge into any investment opportunity, it is a paramount conduct exhaustive research, gaining a comprehensive understanding of what you are entering into. It entails recognizing the associated risks and treating potential losses with the gravity they deserve. If you are contemplating partnering with a new brokerage or a specific asset has captured your attention, a diligent evaluation of all facets of the firm, weighing the pros and cons of association, and delve deep into the associated risk and growth potential are prerequisites for informed decision making. This brings us to the next pivotal principle in Warren Buffett's investment playbook, investing in what you know. Buffett's unwavering adherence to the axiom never lose money is underpinned by meticulous research and intimate understanding of his investment. His strategy hinges on the rigorous examination of financial reports, of industry trends, and a comprehensive analysis of the competitive landscape. These efforts culminate in accurate determination of a company's true value and its future growth prospects. The significance of this insight lies in its power to pinpoint the inherent risk associated with a particular investment, terribly significantly increasing the likelihood of incurring losses. As Buffett seasonally puts it, risk comes from not knowing what you're doing. Consequently, investment in companies or sectors with which an investor is intimately familiar inherently carry lower risk compared to venture into uncharted territory. This familiarity bestows the investor with the ability to discern warning signs, evaluate the sustainability of a business model, and fully grasp the competitive positioning of the company. In essence, investing in what you know empowers you to sidestep potential hazardous investment and make choices rooted in a foundation of knowledge. Furthermore, the third principle in Harvard's comprehensive investment philosophy emphasizes the importance of obtaining high value at a low price. The adage, price is what you pay, value is what you get, serves as the cornerstone of the principle. Buffett's investment prowess lies in high knack for identifying businesses that are priced below their interest worth, presenting an opportunity for future success. A striking example of the approach was business during the tumultuous years of the 2009 financial crisis when many companies floundered. Buffett, instead of shying away from the crisis, perceived it an opportunity. He invested billions in firms like General Electric and Goldman Sachs, deeming them solid virgins. The key takeaway here is that overpaying for an asset can ultimately lead to financial losses, akin to paying exorbitant interest on credit card debt or investing in items with limited utility. Buffett's methodology is centered on securing excellent deals and prospects without overextending resources. In the realm of stocks, this translates into acquiring shares of commendable companies where the valuation remains depressed, mirroring the certification one derives from purchasing high-quality items at a significant discount during a sale. However, effectively executing this strategy necessitates more than just a discerning eye. It calls for a well-defined investment approach underpinned by the profound understanding of what constitutes a company's true worth. In essence, it's a feasible focus on businesses that offer enduring products or service, boosting buoyant earnings with ample room for future expansions. Throughout the investment journey, maintaining distinct criteria is pivotal. This may involve dedicating funds exclusively to more established corporations or just expecting favorable earnings to price ratio and a sustainable debt level. Beyond merely identifying lucrative opportunities, successful investing entails securing them at judicious prices, thus fortifying one's position against unforeseen market volatility. Buffett-Ford's principle encourages a unique form of investment in oneself. He ardently advocated for nurturing one's skills and personal growth, recognizing that this self-investment inherently increases one's value. Unlike traditional investment, the returns from self-investment are not merely symbolic or numerical. They yield tangible and significant returns. Buffett eloquently captured this notion when he declared, anything you invest in yourself, you get back tenfold. The distinct advantage of this investment approach lies in its immunity to external threats. Unlike traditional investments susceptible to market fluctuation, taxes, or confiscation, the gains from personal growth remain resilient. They are shielded from the burdens of taxes and immune to external efforts to preserve them. This investing in oneself not only bestows profound personal and professional benefits, also represents an exceptional avenue of secure investment. Moving on to the fifth principle, Buffett stressed the importance of learning about money. He posited that the true risk in investment terms from a lack of knowledge. Therefore, the more knowledgeable you become about a company and its industry, the safer your investment becomes. For an investor, it's imperative to gain comprehensive understanding of various financial principles, tools, and metrics. Knowledge empowers you to delve into financial documents such as balance sheets and income statement, enabling you to evaluate the company financial health effectively. You will also develop a comprehensive grasp of specific financial ratios and indicators that shed light on the company's standing within the industry. With this invaluable information, you can adeptly apply the principle of the margin of safety, a cornerstone of Buffett's investment strategy. The margin of safety refers to the difference between a company's intrinsic value and the market price of its stocks. The principle revolves around making investment choices that curtail risk and potential downsides. It entails acquiring assets such as stocks or other financial instruments at price substantially below their true value. Warren Buffett constantly employed this principle as a safeguard to ensure that his investment remained profitable. He adopted this insightful approach from his mentor, Benjamin Graham. By purchasing stocks at price less than their intrinsic value, investors create a financial buffer for themselves. Consequently, even if the broader stock market underperforms, they are less exposed to substantial losses. This strategy embodies the judicious mindset of investors like Warren Buffett. It's a savvy investment tactic underpinned by astute risk management and the pursuit of financial growth. Finally, the sixth and last principle encapsulates the essence of Buffett's precision and long-term approach to invest. Focus on longevity. Buffett Stanley believes that holding on to high-quality businesses over the long term is the most effective path of accumulating wealth. His conviction rests on the promise that exceptional companies tend to appreciate in value over time, irrespective of temporary market fluctuations. Buffett's dedication to long-term investing is evident in his investment choices. When evaluating potential investment, he and his partners meticulously assess a company's competitive edge and its capacity to sustain that advantage for an extended period. They see businesses they believe will retain their robustness and profitability for decades to come. A remarkable example from Buffett's commitment to this strategy lies in his acquisition of Berkshire Hathaway in 1964. At the time, the company was underperforming, and Buffett candidly admitted to be the dumbest stock he ever bought. However, he persisted, driven by a determination not abandon the ship prematurely, even when faced with operational challenges and an uncertain future. Buffett chose not to sell prematurely. Instead, he undertook a thorough analysis of the company's operational costs and future prospects. Ultimately, Buffett decided to discontinue the textile operation of Hathaway. Over time, Berkshire Hathaway underwent a monumental transformation, evolving from a floundering textile business into a diversified holding company valued at an stunning $755 billion. In conclusion, Warren Buffett's investment principle, while seemingly straightforward, encompass sophisticated and comprehensive philosophy that is withstood the test of time. His approach revolves around minimizing losses, investing in what you understand, obtaining value at a reasonable price, investing in personal growth, acquiring financial knowledge, and focus on long-term wealth accumulation. Buffett's remarkable success story, particularly exemplified by the transformation of Berkshire Hathaway, serves as enduring testament to the power of this principle. As you embark on your investment journey, this principle offers invaluable guidance, empowering you to navigate the complex world of finance while simultaneously preserving your capital and pursuing sustainable wealth creation.